You've saved up $1,000 and decided it's time to grow your money through investing. The stock market might seem risky or complicated at first, but this video breaks it all down step by step. By the end, the entire process of investing your first $1,000 will be crystal clear, from how the market works to exactly what to invest in and what mistakes to avoid. The stock market functions like a giant marketplace where investors buy and sell shares of publicly traded companies. These shares are called stocks. Buying a stock means owning a piece of that company. As the company grows in value, the price of your stock typically increases too. Profits come from two main sources: the rise in stock prices, known as capital gains, and dividend payouts, small cash payments made by companies to their shareholders. Stock prices move up or down due to supply and demand, earnings reports, economic news, and market sentiment. Despite short-term fluctuations, the overall market has historically grown 8 to 10% per year over the long run. Investing is not gambling, but the market can still be volatile, especially in the short term. Stock prices can drop quickly, sometimes significantly, but long-term investors who stay consistent tend to ride out the downturns and benefit from long-term growth. Risk can be reduced by spreading investments across multiple companies or sectors. This diversification is exactly what ETFs are designed to do. A brokerage account is the platform where you place trades and hold your investments. Beginner-friendly options include Robinhood, Fidelity, eToro, Vanguard, and Schwab. The best platforms for new investors offer no trading fees, a user-friendly app or website, and the ability to buy fractional shares, which means you don't need to afford an entire $500 stock just to get started. For US-based users, M1 Finance is a solid choice with commission-free trading and interest on uninvested cash. For those in the EU, Trading 212 offers similar benefits with low fees and user-friendly features. For low risk and broad exposure to the market, a great starting point is an ETF, an exchange-traded fund. This is essentially a basket of different companies in one single investment. Popular beginner-friendly ETFs include VOO, VTI, and SPY, all of which track the S&P 500 and provide exposure to 500 of the largest U.S. companies. For those who prefer to choose individual stocks, companies like Amazon, Microsoft, or Google offer long-term potential and strong business fundamentals. Avoiding a few key mistakes early on can protect your investments and save you from costly lessons. Chasing hype. Avoid buying meme stocks or trendy assets just because they're getting attention online. Panic selling. Stay calm during market dips. Selling at a loss due to fear can lock in losses unnecessarily. Lack of diversification. Spreading money across multiple assets reduces the impact of a single bad performer. Skipping research. Understanding what you're buying is essential, even if it's just the basics of how the company or ETF operates. After placing your first investment, the next step is to stay disciplined and patient. Checking your portfolio constantly can lead to stress or impulsive decisions. Market ups and downs are normal. Continue learning, stay informed about your investments, and focus on the long-term plan. Consistency matters more than timing. Adding $100 or $200 regularly builds momentum and wealth over time, even if you're starting small. This step-by-step guide gives you everything needed to start investing your first $1,000 with confidence. Leave a comment below and share your starting plan. Everyone's journey is different, but the most important part is starting. Thanks for watching, and welcome to the world of investing.